Actually, I'm not just talking about the Federal Reserve this morning, I'm also talking about the European Central Bank, because since I spoke to you last week, the two largest central banks and most powerful central banks in the world, the Federal Reserve and the European Central Bank, have both met, and they both provided economic outlooks. The economic outlook provided by the Fed is in their summary of economic projections, which is a summary of the views of all of the members of the Open Market Committee of the Federal Reserve, plus the Fed president. Whereas the European Central Bank, it's their European Bank staff outlook, which is put out every quarter. If I look first at the Fed, what surprises me is that the growth, GDP growth in the US was as weak as it was in the year we've gone past. Now, maybe that's a good thing if they're trying to slow the US economy down, that it's already growing at a pretty slow rate, and that slow rate is 0.5% in 2022. Now, what the Fed thinks is it's going to achieve that same heroic 0.5% in 2023 instead of a recession. My own view is you're more likely to get a slight negative number. I talked about that last week. But by the time we get to 24, growth starts to pick up again, and in 24 it rises to 1.6%, and then it gets to 1.8%. And 1.8% is trend growth rate in 2025, trend growth rate, which is the combination of productivity growth rate plus addition to the labour force from just the increase in the size of the US population. So sort of what that really says is we get back to an entirely normal US economy by the end of 24 and through to 25. Unemployment is expected to kick up from 3.8% this year in the US to 4.4, let's say 4.5%. Next year, and the Fed expects that increase in unemployment is what's going to put downward pressure on inflation. It means that expectation of rising unemployment is the reason that they don't have to keep putting up interest rates. Inflation, the personal consumption deflator is the way the Fed talks about it, and they think that that'll drop from 5.4% this year to 2.8% next year and 2.3% the year after. So inflation will be a thing of the past by the time we get into 2024, and it'll be pretty much beaten by the time we get to the end of next year. So what the Fed says in terms of its own summary of what the participants think in terms of where interest rates going is it's got 3 more rate hikes. At the most recent meeting last week, they increased the Fed funds rate to 435 basis points. They think that, based on the summary of economic projections, they'll hike again to 485 in February and 5.1% in March. Maybe they'll go one more than that, but really what that tells you is that by the time you've got to the end of the first quarter, and certainly by the time you get into the second quarter, all of this tightening cycle will have come to an end as far as markets are concerned. And what the Fed then wants to do is it wants to hold rates where it is and just watch inflation go down. And I'm set as it was watches inflation go down. What you'll see is bond rallies. Bonds will rally at that time, but maybe not until that time. Now, the European Central Bank, rather than telling us what a rotten year they had this year, they tell us in terms of their summary of their staff outlook what a good year they had this year, and the European economy grew at 3.4% this year, which is way faster than the US economy, and around about what the Australian economy has grown. The Australian economy has grown about 3.6%. So we've grown a little bit faster than the euro area, but that's a pretty good growth rate for the euro area. Now, what they anticipate is the same kind of growth that the US is having next year, which is 0.5%. and then they expect growth to kick up to around about their long-term trend, touch higher actually in 24, 1.9% and 1.8% the year after. So they think they'll be growing at the same long-term trend as the US. Inflation is really interesting. They talk about headline inflation, but they also talk about core inflation, and I'll talk about both views that the European staff thinks about what's happening with inflation. So the CPI pretty much red hot, 8.4% this year. They think the European Central Bank thinks that headline inflation will fall to 6.3 next year, 3.4 the year after that, and be back at 2% in 2025. But it's interesting when I look at what their inflation levels are when you take away food and energy. Their core inflation is already pretty much under control, which surprised me when I looked at the numbers, that this year their core inflation, when you take away food and energy, is 3.9%, and it peaks out next year at 4.2%, which is really not that high compared to history, then drops back to 2.8% in 24 and 2.4% by 25. Now, one of the reasons I think is that their core inflation is more under control than ours is, or is the case in the US, is their unemployment is much higher than ours is, or is the unemployment level of the US. And I've said before, the reason is unemployment is so high in the euro area is that before Brexit, it was the United Kingdom that was providing most of the jobs in the euro area. And when Britain left the European Union, unemployment then was much lower in Britain, but it was much higher permanently in the European Union. So, but the fact that unemployment, which this year was 6.7%, next year is 6.9%, way higher than the US. That's twice as high as in the US or Australia. 6.8% next year and 6.6% the year after means that their core inflation is significantly lower, and they don't have as far to go. Interestingly, the other interesting thing about the European Central Bank is the person who's in charge of it, the European Central Bank, Christine Lagarde, is the person who was in control of the IMF when the IMF had the job of picking up the pieces last time the European Central Bank blew up the euro area. And the last person who blew up the euro area was Jean-Claude Trichet, who was the previous French president of the European Central Bank, who tightened aggressively and back in 2008, 2009, and he was the guy who provoked the euro area sovereign debt crisis. So what Christine Lagarde has done in doing her quantitative easing program, she set it up in two areas. One was an APP, which is called the Asset Purchasing Program, which does the normal sorts of things of buying bonds, but also the Pandemic Emergency Purchasing Program, which, when I looked at it, really has nothing to do with the pandemic and everything to do with a preemptive strike to rescue those kind of countries that might blow up if you try and tighten policy in the euro area. The PEP, or the PEP, holds an awful lot of Greek debt and other debt from small at-risk countries. So it's kind of interesting that whereas in the Federal Reserve, when they're doing quantitative tightening as they are from now, as they have been the last month or so, they're aggressively selling bonds. There's none of that in the euro area. They're running down the bonds from the asset purchasing program, but they're not daring to do that from the PEP, where they've got all the risky Greek and other debt. So they've learned the lesson of last time the European Central Bank when they blew up the European bond market. So I think we might be spared that kind of a crisis this time around. But what we do know from these programs is all of these tightening programs will be finished by the middle of next year, and then we can get back to normal life in equity markets.